Hey guys, how's it going? So today we're going to be talking about whether the market is going to crash in 2021. And I hope you don't think this is a clickbait video. It certainly wasn't meant to be. But the answer to this question is basically, I can't tell you. However, pretty much everyone knows we're in a bubble right now. The market shouldn't be going up when the economy is not recovering as quickly as it should have been relative to where the stock market has gone in the past year. And we're still in the middle of a pandemic, but the market has rallied to new highs. So people are thinking we're in a bubble, and that's pretty much certain. But we don't know if the bubble is going to crash. The bubble can keep going for a long time. So I'm going to show you kind of some ways you can find out by yourself whether you think the market's going to crash or not. I'm not going to answer the question definitively. I think the market is going to at least retrace in 2021, and I'll give you some reasons for that. But most importantly in this video, I want to show you some tools that you can use by yourself to figure out where the market's heading. Now, first of all, you're going to look at something called a leading economic indicator. Those are the things that will tell you how the economy is doing, and as the economy leads the stock market, those are going to be the most important things to look at. And I got a bunch of useful ones to show you, but I'm going to give you just like a general FAQ on what to look at in general when you're curious about whether the market's going up or down. First, I want to show you one I use a lot by myself, which is this copper gold yield correlation. It's a correlation between all three. Now, all of these things are traded individually, but you can consider them each leading economic indicators. That is, a indicator that kind of predicts where the market's going. Copper is a bullish indicator. If people are bidding up copper prices, it means that industry is doing pretty well. Most industries, especially tech, use a lot of copper. So if copper prices are going up, it tells you that manufacturing is going up, and that's usually a good sign for the economy. Gold, on the other hand, is more of a bearish indicator. If people are buying up gold, they're thinking, I got a hedge, I got to put my money into a safe place. I'm going to put my money into gold so when the market crashes, I won't feel so much pain. And then the yield is essentially saying, where can you put money safely? Right now, the Fed is keeping yield curves really low. You're not going to be able to find a safe place to put your cash. That's exactly what the Fed wants. They want you to spend money, so they're keeping their interest rates at pretty much zero so that you have to invest somewhere. That's what we see with all this FOMO investing, also TINA. If you guys know the term TINA, there is no alternative. TINA, I don't know if we'll find it easily. There is no alternative. There you go. Basically, there's no other good place to put your money except for stocks. And that's a lot of what we've seen in the tech market recently. During Corona, like, where are you going to put your money? The economy's going down. There's not many places to invest. But tech seems to be doing good because, you know, Corona doesn't really hurt the tech market that much if everybody's just working from home, working on their computers. So there's no other place to put your cash. You put it in the tech market, boom, and it's been doing well. So I've been looking at this curve for a long time, and you could probably figure out how to do this yourself, but if you can't, subscribe to my newsletter, and I send this out. I update this once a week or so, and I send it out. What I notice is when this correlation starts to drop, that's when we see big corrections in the market. 2008 was right here. This was the flash crash of 2010. And then we had the post-peak correction. And now you can see it's starting to drop. I was worried about a bubble around here, but when I was looking at these charts, you know, I thought, all right, we're probably going to fall because of Corona, and I did predict that pretty much at the peak. And we didn't see that here with the economic leading indicators at this point, but we are seeing it fall quite a bit, and that is kind of dangerous for the market at present. Now, if you don't have the ability to graph this kind of stuff, I'm going to show you some great places to see one great place to see some leading economic indicators, and that is St. Louis Fed. Now, what you want to do generally after you find your leading economic indicators, you can go here. I think there's an index that shows you like 40 different leading economic indicators, but you can find them online. A bunch of things that you can look at that'll give you a general idea of where the economy is going. But the secret here is you copy this website, just tilde.org, go to Google, type site in front of that, and then a hyphen, not a hyphen, what is that, colon, and then whatever economic indicator you want to look at, like housing. And it'll pull up pretty much everything from that site, and you'll be able to get all of these things, whatever you think is important. You can look at, for example, new privately owned housing. It'll give you these charts. And looking at these gives you a pretty good idea of where the market's going. So we're going to look at about 5 here, and I'll give you an idea of where things are going from here. So first is initial claims. These are jobless claims. And we could pull forward so we can forget all that old stuff when the spikes aren't so high. But you can see during Corona times, the initial claims went sky high. Now they're pretty much tapering off. So that looks pretty good for the market. We had a bunch of jobless claims. Now, not so much. This is always important to look at. But recently, we've been really skewed because of Corona. Next, unemployment rate. Same thing. Corona is really skewing these leading economic indicators, and it might be a case where, this time is different. But in general, if you look at these little gray bars, these are times of recession. And you'll see during times of recession what the trend is. You can see the trends go up during times of recession for unemployment rate. So, Corona might be a bit of a different situation, but in the future, you might want to just track this. If it's going up, you might get concerned. And these gray bars, they're put in there retroactively. They're put in there after the fact. So if you see it going up, you won't see a gray bar until the government or Fed, the Fed in St. Louis decides that was a recession. Then they'll put a gray bar retroactively. So you really got to watch this. Don't look at the gray bars at present, but look at the gray bars in the past to see how this particular economic indicator reacted during a recession. So right now you can see unemployment rate. It's high, but it's going down. It's not a huge issue at the moment. Retail sales, pretty important. It shows you how people are spending their money. And obviously there's a pretty big spike in spending. We got that drop during Corona, but it's back up. It's looking like the economy is in recovery. But one of the big questions right now is that recovery enough to justify these really, really inflated high price to earnings stock ratios at the moment? And a lot of people are saying no. Another thing you want to look at is home sales. The housing market is often a leading indicator for the stock market. And when you see drops, these drops are not very easy to see unless you kind of cut off some of the older dates. But you'll see the housing market tends to drop during a recession. And the stock market kind of lags this. So you might see it start to drop, but the stock market's still high. The stock market will probably begin to fall after you see this drop. We also got industrial materials. I don't know why there are no recession bars here, but you can go back and take a look, perhaps 2008 or whatever. But generally the price of industrial materials falls because people aren't producing as much. Right now it's on the way up, which is a good sign. And debt. Debt is never a good sign, but it's just been going up ever since whenever. So this one's hard to tell. Theoretically, you don't want a high debt You want to be careful when there's a huge debt. But, you know, the Fed, what they're doing these days is just pumping out money and keeping interest rates low. So we don't know how long this can last, but so far it looks like they're pretty committed to just keeping things going this way. So, I mean, these are the economic indicators I typically look at, and they're all looking pretty much like in recovery state. So none of them are looking really bad at the moment, but you got to consider the stock market is really inflated at the moment, and if you believe in this correlation between copper, gold, and the yield, well, it's not looking so good. I mean, I nailed it last time. I remember around here when it started to drop, I freaked out and I started shorting the market, and that paid off for me. I shorted the market at the top of Corona, but after that, I didn't really go one way or the other. I've been trading pretty much gap trades and going sideways and earnings trades. But right now, I'm starting to get a little concerned because it's dropping pretty far. It's a really hard market to call. I mean, we know that tech's in a bubble, but we don't know when that's going to pop. And part of that reason is retail traders have gotten really powerful these days, and they're very, very bullish, very euphoric, and they're speculating on the upside with a lot of call options, which is forcing institutions to buy stock. So, you know, this is really inflating the market, but we don't know how long this can last. It could last a while longer. It's a really hard market to call right now. I think there's going to be a pullback in 2021, but when? Though, it's really just like you just got to wait until people start giving up. And I don't see people giving up anytime soon. However, at the time of speaking, late January, I believe, late January, we are seeing a wedge up in the stock market. And wedge up is not exactly a reliable bearish call, but what you're seeing is higher lows, but we're still seeing higher highs, but there's a resistance level forming. And about 60% of the time, the stocks can't push up above that resistance level, and you see a retracement. So you got like a 60-40 chance here of the stock market pulling back, but there's also the possibility that that resistance is broken and we just continue another rally upward. Still, this wedge pattern is more bearish than bullish, so right now I'd be a bit careful. I'd be leaning more toward the bearish side. Definitely the risk versus reward is in favor of the bears, but it's just a hard market to call right now. There's so many things in a bubble. You got GameStop that's being pushed up by Wall Street bets and all of these retail traders. You got Tesla, which is just non-stop rally since Corona. And Tesla, if you look at the valuation, it's ridiculously valued. It's like, I think the market cap of Tesla is worth more than all of the auto manufacturers in the world right now, something like that. These situations cannot last. The only question is, how long can the shorts stay solvent, and how long will the bulls keep pushing it up higher? It's just really hard to call right now. But I'm sorry I can't give you a straight answer, but I hope this has helped you. This video has helped you. Basically, you just search for leading economic indicators. Indicators is better. You can find a list somewhere for sure. And then whatever indicator you want, like debt, and then type site, and then paste that fred.stlouisfed.org, and you'll get a bunch of nice charts you can work with. It's all free, and you got these little, I mean, you don't even have to research anything because you got all this reference here, basically. If you can see during the last recession what happened, you can figure it out most of the time. Again, not exactly a great video for you guys. I can't give you a definitive answer as to whether the market's going to crash or not. But hopefully this has been helpful. If it has, please like and subscribe. Thank you.